So this is me, to be followed by Nicola with a very specific analysis of trade and international markets, but I'll give you the global overview. Yep, flip. Okay. It was supposed to be, what is it, the quote, a beautiful soft landing, as we heard yesterday. It wasn't very beautiful, and it might have been soft, but it's not a very optimistic condition that the global economy finished 2024. It is true that our global growth forecast, we had to revise it very slightly up. So we projected 2.7% for the global economy for last year, and it actually grew by 2.8%. So it's a very slight, minuscule revision up, indicating in large part some uptick in large economies such as the US. But as Nicola will be explaining, a lot of it was due to so-called front-loading of trade orders and also consumption spending in anticipation of some shocks and uncertainty and difficulties that were due to come already in 2025. So a lot of the dynamism that is still in statistical reports from other agencies covering the last months of 2024 and the opening months of 2025 is really due to so-called front-loading, when people were rushing with completing the contracts, shipping stuff, and consuming also and buying goods and services in anticipation of more hard things to come during 2025. We do warn that this dynamism observed in the past 6 months is going to be transitory. It's not going to last. In fact, we anticipate a slowdown for global growth in 2025 and a slowdown in major economies. We can explain why, but we do very specifically in the context of developing countries and those countries who are facing severe debt payment difficulties. We do warn of the conditions of a perfect storm, because the global economic environment is becoming more challenging and uncertain. Global financial conditions are continuing to be tight, with high interest rates, with pressures on credit, and with less connections between trade partners. And it also complicates macro-financial context in the developing countries who would have loved maybe to make it less restrictive, but they are likely not to be able to do that. So on the graph on the right-hand side, you see the estimations for 3 years in a row. And I think our main message is this. The world economy had been weakened not just by the COVID shock. It arrived into the COVID shock in a fragile state post-financial crisis. And it never really recovered that growth potential. That growth potential was also lost for many economies in the global south that statistically show some robustness in terms of growth. We see some Asian economies, Indonesia, India, of course China, that are growing around 5%, some are growing more than 4%. So there is pockets of growth, but they are at the moment do not build up into the aggregate picture of robust demand and certain engine that would propel global macroeconomy for the months ahead. Instead, we see quite a sharp deceleration in the US economy. We see a slow stabilization at a slower point in China, and some uptick in European economy, but from a very, very shallow and small base. So all these 3 centers of economic activity together are now unlikely to generate that engine for consumption, the engine for demand that can sustain global economy for 2025. So we do see a slowdown. And to be honest, in light of what we heard yesterday or last evening, I think our projection of 2.6% for the global economy is going to be an overestimate towards October. I think it might be lower. I will also warn you that in our technical analysis, global recession is marked at 2.5%. So statistically, we calculate that the global economy is in technical recession when global growth is at 2.5 in real terms. So 2.6 is just above that. And it's not a very optimistic, certainly not a beautiful soft landing that some might be projecting. Next slide, please, Nicola. what gives us all this pessimistic insight is the spiral of uncertainty that was unleashed from January onwards, really, but also before. There are lots of indications now and lots of indices of uncertainty being published by a variety of outlets. We went for something called Global Economic Policy Uncertainty Index that was created a few years ago on the basis of thousands of newspaper and analytical reports that mention worries about geopolitical uncertainty, trade uncertainty, and other policy shifts that are worrying investors, that are informing their planning decisions, that generate investor caution and make them very anxious. So as you can see on this chart, global policy uncertainty at the moment is a 20-year high. It has only been that high around COVID, but even in 2008 financial crisis, when the whole capitalism was sort of on the brink of implosion, it was lower than that. So in terms of simply what policy shifts can generate to trade, financial and economic connections, people are very worried. And it's not a transitory anxiety. It generates a whole spiral of economic expectations that do have macroeconomic consequences. Some of those relationships you see on the slide, but overall we see that from two sides, from on the one hand lack of policy clarity and the chaos generated by certain announcements that are made and then they are reversed, and then they adjusted or negotiated. Lack of policy clarity means that key decision makers on investment, production, planning, allocation, signing agreement are much more cautious. They do not go ahead with the plans, and it affects hiring, employment, and trade partnerships, and overall slowing economic activity down. On the other hand, trade restrictions themselves, and trade is an important part of global interconnectivity, trade restrictions do generate disruption into supply chains, into production patterns, into production facilities, therefore disrupting planning and financial considerations and financial flows themselves. In turn, there is, although forecasters are still modeling what will be the spillover effect of a variety of tariffs, there is one particular area of the global economy that immediately reflects anxiety, and that is the financial system. Next slide, please. So the world suddenly became a riskier place. It actually is a riskier place than it was in 2016, 2017, when the first round of tariff escalations was put in place. On the slide, you see two indicators of just how unusual and how unprecedented this worry, the fear, is. On the left-hand side is the price of gold. Really, nobody uses gold in real life. It has some intrinsic value, but it's not particularly useful. Central banks of many countries have been buying up the gold to diversify their central bank reserves, but it's not a very recent phenomenon. It's been going on for some time. What is recent, however, is that in the overall fear about the prospects of financial assets, where to park your money, what will guarantee at least, if not the yield, if not the increase of your value, but the preservation of value, investors are rushing back into gold like in old times, seeing that this is a safe haven asset that would really protect them from this complex chaos that is unfolding in the global economy. So gold is at historic heights as well, just like that policy uncertainty. At the same time, another core financial asset, a safe haven financial asset that is usually regarded by the markets as a bet that can never go wrong, is US Treasuries, and in particular 10-year US Treasuries, where the yields, you can see that this is the right-hand chart. Traditionally, advanced country governments, in particular US government, can borrow in the markets very cheaply. It's very unfair to developing countries who have to pay several times more that, and even large emerging markets have to pay more in order to borrow. But really, the yields on US bonds were traditionally quite low, and it was one of the financial leverage dimensions of financial power. But recently they have gone up, which means that investors are demanding more compensation to actually hold these securities because they're now worried about the credibility of this particular economy, whether these safe haven assets will actually be the safe haven assets guaranteeing the yield and the payouts that they have to by law, by constitution. So there are other indicators too. We use the fear index, we use some other volatility, but really there is an immediate worry about some certainties that had long been certain in the global economy, but now they expressed in financial worries, and financial markets are the first to reflect them. Next slide, please. We actually looked into the nature of financial volatility and its implications for developing countries and found out this. On the one hand side, although all markets are volatile, some are more volatile than others. The volatility doesn't necessarily mean negative disruption immediately. Volatility means that there is more activity, more liquidity, and more bets are being taken in particular securities and markets. So the volatility fed into the asset boom in technology stocks in advanced markets. This is the chart on the left-hand side. You see the divergent trends between the companies who want to be capitalized in global markets from the developing world. This is the blue line. And the orange line represent big corporations in the S&P index that are dominated, of course, by the technology sector. You can see that since they are now particularly divergent, meaning that there is a huge interest of investors to invest mainly in technology sectors. And out of those technology sectors, it's the companies from the advanced markets that get the most capital. That means that the little capital that developing countries are able to attract, and there is volatility of capital flows that Nicola will cover, it's unlikely to go in other sectors. So the financial, they are much more exposed to financial speculation and the risks that come with it, including on their currencies and fiscal balances. We also calculated that the financial volatility, again, is historically high, but it's much more high today in developing countries, in the emerging markets that participate in finance, rather than in developing countries. And that bodes risks to even large emerging economies who are part of the global financial system in a more integrated way. Next slide, please. There is a systemic impact of uncertainty, as I said. It all carries macroeconomic implications. On the one hand, the impact of uncertainty on the trajectory of these safe haven assets on bond yields go beyond government. It affects all interest rates, and as we all are now financialized citizens, we all have some sort of debt relationship or a credit to be paid back. It will affect households, companies, firms, municipalities and other actors who are in any way financialized and therefore a borrower. That would mean that the pressures on interest rates remain to be high. That means that the financial conditions in global macroeconomy are continuing to be tight for the months ahead. At the same time, we also see some stagflationary risks in major economies, and there is a risk that central banks will resort to very traditional monetary tightening in reacting to prices that are certain to go up. For the developing country prospects, the complicated macroeconomic picture means that they will now have to divert even more resources to debt repayments away from their critical spending needs on public and social needs. This is going on in the context of new fiscal conservatism, as we say, that turn to more conservative spending structure, when in all major economies much more resources are diverted to military spending, away from, for example, development assistance, away from contributions to multilateral institutions and to development. So all this makes the financial context for developing countries much more difficult than it was in 2024. As Penelope already highlighted, more than half of low-income countries are in debt distress, and for them, this situation is really, unfortunately, heralding a perfect storm of probably not just a development, but also a financial and economic crisis and a catastrophe. Central banks in developing countries will find it more difficult to be more relaxed in their monetary regimes. They will have to maintain tight policy rates and tight conditions. Overall, all this makes it more certain that the global engine of demand in the global macroeconomic context will even be much more tight and difficult, because developing countries themselves will find it difficult to stimulate domestic demand internally. I think I'm, next slide, Nicola, it's you. Yes, there is some hope. There is, out of the gloomy context, we did find something to suggest to you in terms of policy takeaway as what can be done. US remains the largest importer in the world, but its significance in world trade has been diminishing, and so has its significance for many developing countries' exporters. In fact, we see that South-South trade and other trade partnerships, mainly driven by the rise of China and other emerging markets, have been on the rise. And we do call for leveraging these already existing trade partnerships and multilateral trade networks, because they already provided a source of economic resilience to a lot of countries in the world. And in particular, those countries, remember that I said that many economies in Asia grew robustly in 2024. They all are around Asia, Asia Pacific. Of course, it's centered on China, but not only. And it's important to understand the mechanisms that provide that resilience to that particular region of the world. So there have been massive shifts in the topography of world trade, with developing countries assuming much more share, a much larger share in world output, but also in partners away from the US and European Union getting higher in their significance and therefore in their role as major export destinations for developing countries. It's a source of growth, it's a source to be capitalized on, and it's a source to be used. Next slide, please. We also observe that the strategies of building open regional or regionalism partnerships, and in particular intra-regional trade, have been significant for the success of many Asian development models even now. So the calculations, we know that developing countries tend to trade more between themselves than northern countries do. But in particular, it's the intra-trade for the Asia-Pacific region and South Asia that has been particularly robust and expanding. You can see it on the right-hand side. It also explains why in 2024, the economies of South Asia, Southeast Asia provided more than 40% of growth to world GDP. It's a very large contribution, and should these partnerships be enhanced and scaled up, there is a lot of potential for growth in real terms there. I will come back on policy messages, but I'm handing it out.
Thank you, Anastasia, and good morning, everyone. And it's a real pleasure for me to be with you again after the briefing we had during the fall last year, where my colleague Cameron and I had the chance to brief you about the Trade and Development Report. Today, as Anastasia mentioned, it's a great opportunity to release in advance what the next publication that we will release next week will say about international trade and capital flows to developing countries. So yeah, I will focus mostly on these two areas of international, what we call international market. And as Anastasia mentioned already, the buzzword these days is obviously uncertainty. You open the newspaper, you hear any presentation from an international organization about the current economic situation, and you read, that word all over the place. And this high uncertainty is also partly the reason why we have not come up so far with an annual estimate for the evolution of international trade in 2025. Because at the current juncture, I think nobody can realistically assess for now how the trade flows will really evolve by the end of the year. So rather than trying to embark into that exercise, which is likely to be revised even in a few weeks' time, the aim of my presentation today is rather to discuss what we have observed since we released the Trade and Development Report in October, but also to try to make sense of some of the some kind of mixed signal that we have observed in international market over the last 6 months. Obviously, I will be delighted during the Q&A to come back to some of the questions you might have, especially in light of the announcement that were made yesterday evening on the other side of the Atlantic. So, with this introductory remark, So with this introductory remark, let's now delve into international trade, which will be the core of my presentation, before I say a few words about the financial flows to developing countries. So Anastasia already mentioned that there is a very high uncertainty. And in fact, if we look at a specific index of trade policy uncertainty, we can see that it has reached unprecedented level since basically the data for that index exists back into the 1960s. I just updated the data yesterday for the month of March. We are, way above what we have observed even during the pandemic, which was already a very stressful episode for trade. And obviously, trade uncertainty can mean many things. Here, it's just an index that basically look at the number of time this word is associated in some newspaper with trade policy. And you can see that, just to illustrate a little bit my talk, that the current uncertainty in trade are just extremely high. And in fact, I think it's fair to say that the trading system faces its most significant challenges since basically its inception after the Second World War. In a sense, the ongoing transformation that we have discussed in the Trade and Development Report has continued, but with rising trade tension, now the expected slowdown of the global economy, and also the elevated uncertainty, it will probably accelerate even further that reconfiguration in the year ahead. And while all the impact of the changing trade policy are difficult, it's not impossible to predict at the moment. I think one thing that is clearly evident for the time being is that, as I mentioned, global merchandise trade in particular is severely under pressure these days. And in fact, if we look back even a few months ago, the headline figures for international trade indicated a rather benign outlook for global merchandise trade. In this slide, you have the evolution of trade flows for certain group of economies and also for the world as a whole until, in real term, until basically January 2025. And as you can see, in fact, the world trade experienced in the last quarter of 2024 its strongest quarterly growth over more than 2 years. So basically, after we had the kind of rolling coaster episode of after the pandemic, growth world trade was relatively subdued, but slowly, basically, it picked up, and that represent that's what mostly based on some double-digit export figure coming out from China, which was leading that expansion. And also it mirrored basically a very strong import demand from the United States, where we had plus 7% growth over the in the last quarter of 2024, but also economies like in Latin America and also some other key advanced Asian economy whose import demand has been pretty strong. Elsewhere in the world, as you probably know it, especially in Europe, the situation was more complicated and subdued. But overall, let's say, there was until recently, I would say probably observers were relatively bullish about international trade. Back at the end of 2024, there was lots of expectation that maybe some of dereglementation of policy for key firms and all that will probably help them. But all that narrative has basically disappeared. And in fact, our reading of the current situation and some of with regard to the trade uptick that we have observed in late 2024 and early 2025, as Anastasia mentioned, is in fact likely to be transitory in our view. Partly because there are evidence of front-loading orders ahead of anticipated tariff, as Anastasia mentioned, but also because if we look at the consumer sentiment in the United States, which was a key driver and that explained the robustness of import in the United States, that has declined significantly in recent months. Also, we have other set of indicators that support a more pessimistic trajectory in the months ahead for global trade. If we look, for instance, at the new export order for the purchasing manager indices, the so-called PMI, we can see that they have moved below the neutral point of 50% in many large exporting economies. And also, looking at the Shanghai Export Container Freight Index, which can be seen as a barometer of the health of trade dynamic, that particular index has declined by 40% between January and March this year. So all that is to say that, in fact, after the rather strong quarter that we have observed in late 2024, we cannot rule out a sharp reversal in the months ahead, particularly because lots of the support for that uptick we know were temporarily, as basically they were firm and household stockpiling goods ahead of the anticipated tariff and so on. Now, another way to look at how the observers have become more pessimistic about the international trade and in particular about merchandise trade is to look at the various release of the UNCTAD Trade Nowcast, which basically on a weekly basis assess or try to estimate how the current trade flows will be, how strong, let's say, the trade flows will be during the current quarter. So that exercise started in early December. At the time, we had only a few set of data. And as you can see from that chart, at that moment, if we look at merchandise trade in real term, the expectation for a quarter-on-quarter growth on an annualized basis was about 4%. That's the orange line on the left on the chart. And as new data came up over the weeks, that figure was revised consistently downward, and in late March it was even below 1%. Actually, earlier this week, on the 1st of April, it even went to negative territory, but I didn't have the time to update the figure. Now, what we can also see from that chart is that if we look at services, though the data for that indicator are only in dollar terms rather than in real term, so in nominal dollar, the growth there has remained so far much more robust. And that's partly because services so far have remained relatively immune from the threat of tariff. But again, we are not 100% sure that will continue in the near future, because there might be some retaliation effect that might kick in down the road. Having said that, what we emphasize in the last trade and development report, that overall trade in services has remained firmer over the years. That's still so far ongoing. And in particular, there are all the digitally delivered services that basically drives that trend, though we know that the bulk of it mostly come from advanced economies and also China. But we have had some positive news, specifically from Latin America, with countries like Chile, Argentina, Peru, who experienced double-digit export of services in the recent quarter. Now, before closing the section on trade, I would like to, we know that the current heightened policy uncertainty pushes the decision maker to revisit, their integration strategy. In this context, companies seek to basically greater market diversity and are also scaling up risk management effort. Government are reassessing their trade policy, weighing the benefit of open trade against the need for protecting domestic interest. We also have had a very volatile economic landscape that probably call for agile adapting measures to navigate the growing vagaries of international trade. And ultimately, we believe that addressing this uncertainty still requires countries who recognize the mutual benefit of international trade to maintain a coordinated effort in fostering a stable and predictable trade environment. So, before closing this section on trade, I would like to just make an additional remark to say that we know that the United States is, for many countries, one of the key destinations for their merchandise export, but that the share, let's say, the relative share of the United States in the export of the developing country has diminished over time, and there is now a growing role for the South that can probably offset part of the negative expected impact that we foresee with the slowdown of the United States economy and also the tariff that they have put in place. And also, the South-South economic integration can offer some opportunity for many developing countries, basically to diversify further their trade and beyond. Now, turning to financial flows to developing countries, again, here it's an area we are still relying on some some proxies and some data, because the balance of payment data tend to come up with quite some lag. But so far, I would like to stress two worrying trends that we see appearing on the horizon. One is obviously the decline of ODA from key donors, and also the second one are the worsening financial condition, at least for a number of developing countries. So in the case of ODA, the early estimate that we have gathered point to a cut of a decline of about 18% of ODAs these years, compared to what was expected in 2023, or more roughly, let's say, a fall of ODA flows of about 74 billion, according to this source of information, the budget cut tracker. And we know that the cut announced came on top, of a declining trend in ODA to developing country, which peaked in around 2020 and then already went down by 2023. And now moving to financial flows to developing country, here we rely on one indicator that we have on a daily basis, and that allows us to basically track what is the evolution of the yield and the spread that developing country paid on their public debt. And as you can see there are two types of, two different news. The first one is that if you look at the spread, so basically the spread vis-a-vis the US Treasury bonds, so basically what is observed, the yield that is observed for the debt of developing country, being either what we consider as emerging market economies or the frontier market economies. So the spread vis-a-vis the US Treasury has continued to diminish in recent months, and that's the chart on the left. Now, if you look at the yield, which is actually what matters when it comes to basically rolling over your debt, or basically or simply, the financing cost for those government, we see that the yield, though they have partly declined for the group of frontier market economies, which are the market that have more recently, let's say, integrated into and have started to tap the international bond market. It has decreased, but it remains at level that is much higher than what we observed prior to the pandemic, or even basically before there was a raise of the interest rate in major developed economies in 2022. So that's, in our view, quite worrisome, because we know that, it represents, and my colleague Keith will come back to that later, but it represents a significant burden for developing country. So as long as there is basically nothing is done to basically diminish those refinancing costs, the situation will remain extremely challenging. With this, I would like now to hand over again to Anastasia for some concluding remark, and before we move to the Q&A. And thank you very much for your attention.
Thank you very much, Nicolas. So I will now sit because it's our conclusion. Clearly, it's shorter than the main TDR foresight into 2025. We do warn of a constellation of risks that are compounding into quite a systemic effect that is very likely to be negative for the majority of developing countries. We do warn that many, especially low-income economies, in light of the analysis that Nicola just presented in terms of their financial integration, are very vulnerable to the risks of a perfect storm when several negative forces coincide together. It's deteriorating external environment, now marked by fragmentation and uncertainty. It's onerous debt burden and very expensive debt service, and weakened domestic but also global growth prospects. But even in this condition, or I would say especially in these conditions, it is crucially important to leverage those trade partnerships that already have been working for you and can deliver more, even beyond trade, because trade is not just a trade relationship, it's an economic relationship and a financial connection. So this partnership potential include economies across the global south, but not only, and it can certainly help developing economies mitigate the risks and bolster economic resilience through better connectivity across trade, value chains, and finance. It is also important that in the context of escalating tensions, and it's inevitable that we do note the conflict, the war, the trade escalation and the retaliation. If you open any of the analysis, it's just there. So we do caution that simply retaliation will not deliver global economic stability and growth for all. It will be a mistake and a very negative shock. Fragmentation will make things much worse for everybody and developing countries in particular. So instead of a cycle of retaliatory measures or even announcements, we call on building on existing trade and economic partnerships and deepening policy coordination, including on sharing best experiences, access and coordination of data, cross-sector analysis, sector inquiries, because a lot of these methodologies and data already exist. It's just a question of political will, including in the developing country context. So these need to be scaled up internationally and regionally, and it can be the only way to sustain the perfect storm that unfortunately is unfolding. So with this, I finish.